If you went to bed Tuesday, February 4th at about 4 p.m. Eastern, you might have thought, okay, silver finally found its footing. The candles got smaller, the selling slowed, it looked like panic might be done. And then February 5th showed up and chose violence. Today, silver got hit again, hard. Reuters reported spot silver down about 13.6% around late morning, trading near 76 and actually printing down to 72. And in a broader commodity convergence, Reuters described silver tumbling as much as 15% in the sell-off. Now, here's what makes this specific window from February 4th at 4 p.m. Eastern through today so important. This wasn't slow repricing. This was forced behavior. This was exchanges and big players doing what they do in a stressed, leveraged market. And there's one detail out of Shanghai that is dramatic, telling, and must be understood. The Shanghai Futures Exchange publicly announced that 6 groups of actual control relationship accounts exceeded their intraday opening volume limit on relevant contracts. They crossed the exchange's enforcement threshold, and the Shanghai Futures Exchange imposed restrictions on ongoing new positions for those customers on the corresponding contracts. And at the same time, Bloomberg reported that a Chinese billionaire trader, Bian Zhiming, built the largest net short position in silver on the Shanghai Futures Exchange, basically a massive bet that silver would fail. So in this video, we're going to do one thing. We're going to go step by step through what happened in this window, what's verified, what's interpretation, and what the implications are, especially if you own physical silver versus trading paper. So make sure you stay tuned to the end, because these details are going to become very important for those of us that have silver holdings. All right, let's start in Shanghai, because that's where the fingerprints are. Then we'll move through Europe and into the U.S. session, where geopolitics, the dollar, and margin pressure all stacked up on the same side. And then we're going to talk about the big disconnect, what the paper market is doing versus what's happening with actual metal. Now, quick favor, if you like this kind of clear, no drama breakdown when markets are moving fast, subscribe to the channel. All right, one quick disclaimer. Before we go deeper, this is for educational and informational purposes only. It is not financial, investment, legal, or tax advice. I don't know your personal situation, your goals, or your risk tolerance, so nothing here is a recommendation to buy or sell anything. All right, now, let's start where this aftershock story really breaks, and that is in Shanghai. Here's the clean version of what the Shanghai Futures Exchange did today. The SHFE published a notice dated February 5th stating that these 6 groups of accounts linked by an actual control relationship exceeded the intraday opening volume limit on relative contracts and reached the processing limit standard for enforcement. This SHFE said this violated Article 16 of its trading behavior management measures, and the exchange decided to impose a restriction on opening new position for the affected customers on the corresponding contracts. Actual control relationship account group means accounts the exchange considers connected, controlled by the same party, or acting as a linked group. Intraday opening volume limit is a cap on how many positions you can open in a day. Restriction on opening new positions means you're not allowed to add new risk on that contract because you tripped a rule that's specifically designed to stop abnormal destabilization types of behavior. And here's the key. This was about opening volume. Opening volume is the creation of new exposure. It's aggressive positioning. Now, does the SHFE notice use the word manipulation? No. Does it say aggressive shorting? No. Does it say those accounts caused the entire crash? No, but it does confirm something that matters a lot. Concentrated, abnormal, rule-breaking activity happened, big enough and clear enough that the exchange stepped in and named it publicly. That is a very big deal in Asian society. Shaming is a very, very important fact of the way these cultures operate. Now, my interpretation is this. This strongly suggests abnormal, concentrated flow during extreme volatility that the exchange decided could not continue unchecked. So let's keep it real. Direction and intent aren't specified in the notice. Now, layer in the second Shanghai bombshell, the big short. Bloomberg, roughly at the same time, reported, and again today, that this gentleman, Biang Zhiming, I hope I'm pronouncing that correctly, who's known for making billions from gold bets, built the Shanghai Futures Exchange's largest net short position in silver. That means he profits if silver falls. Why does that matter in the February 4th after 4 p.m. to February 5th window? Because when you have a very large motivated short in a stressed market, it changes the way price behaves. Every little bounce becomes an opportunity to lean on the market. Every attempt to stabilize runs into overhead selling. And in thin liquidity, that selling can have outsized impact. Not because one person controls silver globally, but because big size in a fragile tape acts like a lid. So now you've got two Shanghai facts that rhyme. One, they publicly restricted the 6 linked account groups for exceeding intraday opening volume limits. And two, as reported by Bloomberg, the billionaire who built the largest net short in silver, Shanghai silver. That's not proof of a coordinated plot, but is a very loud sign that Shanghai flow was not normal retail buyers quietly buying jewelry or gold bars like we would as individuals. All right, now let's shift to Europe because the story gets even more interesting. Now take that Shanghai setup and roll the clock forward. In this specific window, a major narrative shifted, and that's regarding geopolitical risk. Reuters reported that commodities sold off broadly as geopolitical tensions ease, pointing to a U.S.-Iran agreement to hold talks and a constructive call between the U.S. and Chinese leaders. Now, remember, the market trades headlines first and debates them later. So when the headline says talks, algorithms and risk managers read it as less immediate fear. And when fear comes out of the market, a lot of crowded, hard asset trades actually get unwound and fast. You could see it in oil too. Reuters reported oil falling more than 3% on easing supply concerns after the U.S. and Iran agreed to talks in Oman. Here's the important point. In a risk-on, risk-off tape, commodities often trade like a herd. When the herd is buying, uncertainty insurance, everything gets pulled higher together. When the herd is selling, because risk is easing, everything gets pulled lower together, even if the fundamentals are different. Okay, now let's shift to the U.S. So by the time the U.S. traders were fully awake today, the setup already looked like this. Shanghai was unstable and being policed. A major fear premium narrative had just softened. Liquidity was thinner, and the market was already stressed from recent volatility. Now we hit the third force that turns the down into down a lot, and that is margin pressure. When volatility spikes, margin requirements tend to rise. Brokers tighten, exchanges tighten, risk managers tighten. And when that happens, people don't sell because they suddenly change their mind about silver. They sell because they literally have to. Reuters put it plainly today. Investors were liquidating precious metals holdings amid a stronger dollar and broad market sell-offs. And one market strategist specifically pointed to margin issues. People covering metals positions because of losses in their equities. That is the anatomy of a liquidation wave. Now, we've talked about this before, that when the markets start to get hit, people go to their hard assets, their good assets, their performing assets to raise capital. And I think that's exactly what we're seeing in this market. So think about it this way. If your broker says, post more money by this afternoon or we close you out, you're not going to have some kind of like philosophical debate about silver's long-term role in solar panels. You're selling what you can sell. And the most liquid thing to sell is paper exposure futures, options, things like ETFs. Now let's talk briefly about India and the picture there, because India is very big into silver, and today India also tightened the screws. Multiple outlets in India reported that MCX's clearing entity imposed additional margins on bullion futures, including an extra 4.5% margin on silver futures, effective today. Same dynamic as everywhere else. Higher margin means same position, more cash required. More cash required means forced liquidation for anyone who can't meet that call immediately. And forced liquidation in a thin market is like gasoline on a fire. Now, before we talk about physical, I want to stop and make one thing crystal clear, because this is where a lot of people get literally wrecked. The price you see on a screen is mostly paper price. Futures and derivatives are designed for liquidity and leverage. Leverage is why price can move like a trap door. Physical metal does not behave the same way because it's physical and it can't be like margin called. So when you see a 13 to 15% drop like today, it doesn't automatically mean silver is suddenly less useful. It often means the paper market is flushing leverage. And today's flush had extra fuel, Shanghai enforcement, a massive short presence, easing geopolitics, a strong dollar environment, equity weakness, and margin tightening in multiple venues. So now here's the disconnect, and this is where our story gets interesting for physical buyers. While paper was getting liquidated, we also evidence a fiscal movement, real inventory changes. On the COMEX side, the CME's daily COMEX Silver Depository Report around this window shows meaningful stock changes, including a total eligible withdrawal figure of over 3 million ounces on the report for February 4th. That's 3 million ounces moving out of eligible on the activity day. Now, I'm going to be responsible and give you the correct number. COMEX reporting includes categories like eligible and registered. Metal can move between categories by adjustment without actually physically leaving the building. So this is not me saying default, but it is still a meaningful signal during a paper washout, because it means during the same window the paper price was getting wrecked, real inventory accounting was slowing big movement. That supports the idea that what you're watching on the screen is not the entire story. And from our seat in the physical business, what we see on days like this is not everyone disappears. What we see is a split personality. Paper traders get forced out, physical buyers start hunting, and spreads and availability start mattering more than ever than that headline ticker. So now the big question, what are the implications? Well, for us, it means we need to stay the course. Our reasons for being in our metals positions have not changed. And just because we're seeing all these factors take place, in particular in Asia and even a little bit in Europe, we need to be strong, stay where we are, use our service like our auto invest at Summit Metals and take advantage of these dips. This is a great time to be acquiring your metals. So thank you so much for tuning in. I know this is a more detailed, more specific representation of what's happening in the market, but because we've had a couple of these big moves, I wanted to go a little deeper to help you understand why these metals are moving like they're moving. So thank you much for tuning in, and happy stacking.